All right, good morning, everybody. So, yesterday was a pretty good day, and the expectation is that today should be just as decent. I do want to keep an eye on the clock a lot today. 8:30, 10:30, 11, 11:30, 1 o'clock. These additional auctions kind of break the idea of our lunchtime window that we would normally carry. So, we got to recognize that and have no expectation that the market is going to consolidate into that lunchtime window. Normally, as we get through 10:30 into 10:45, we start to expect whatever the market is doing to stop and kind of tighten up, get a bit of consolidation as we get into that lunchtime, and then we start looking for the end of lunch as the start of the afternoon session. We never quite know where the end is going to be. We just recognize within the candles that lunch has finally ended and we're getting into that afternoon session. But on a day like today, it's going to just be a nonstop, all day opportunity. So the clock is going to be your friend today. Just keep your eye on it throughout the day. It's going to, with this kind of activity, any of these could conflict with each other. So, things can go from positive to negative or negative to positive and then back again. If they're all negative, obviously it could just send us to the downside. If they're all positive, it could rally us up. But you got to kind of expect that we wouldn't see such clean, clear signals from all of these diverse economic uh, inputs today. And that would also be assuming that they're all going to have clear signals when a lot of times the numbers we get are muddy and they just make things worse, not better. They don't give us clear guidance. They leave us looking for more answers. As we do every day, want to start the S&P, kind of taking it from the middle, asking the question, what can we do at this point? The market can only do three things. So we take the time to map it out in advance. The range right now is the low of our own Globex to the high of our own Globex. I would consider this absolutely zone one or our first range. And we could stick the range just right there and call it good. I find it really unlikely that we would do that, however, right? So while it is something that could happen, it's also the least of my scenarios that I would expect to happen. If we did do a day like this, it would look very similar to Tuesday, right? It mostly stayed inside of its own Globex. Yeah, it kind of peaked out the top, right there at the very end, and it did peak out of the bottom, but for the most part, it stayed within its own Globex. So it would be the same kind of scenario, maybe a little bit to the upside or a little bit to the downside, or heck, in this market, maybe both, but still maintaining the lows of this range, this new zone or section from yesterday where we're at a lower valuation and we would just expect to stay there. That would be theory number one. If we did do that, once we run through these pivots a few times, they have no validity left, right? We wouldn't focus on yesterday's low anymore. We wouldn't focus on yesterday's close or Globex open, because once we cross through them two or three times, they have nothing left in them, right? Having said that, if we do get back up to the Globex high, there's very likely going to be a response there, at least the first time. Same thing with the Globex low. If we get back down to that spot, there's very likely going to be a response at least once, right? Call that first touch, first blush. So if that's theory one of range, theory two of range would be that we still are inside yesterday's price action from yesterday's highest value all the way down to yesterday's low. And if we add to that what we already have done in the overnight hours, then this is the entirety of our range today. Anything moving inside of this box from 40.50 all the way down to 38.91 would be a part of a range day. Now, inside of that range day, we can have very, very good price action. I'm not saying that it's some kind of range that you can't trade or that you shouldn't trade. No language like that whatsoever. More than enough room to trade. There is a little bit of a history, though, that when you are trading in a range day, it's very likely going to be a more difficult kind of trading day than if we weren't in a range day. So if you are losing frequently already and you find trading difficult, you're probably going to find trading within a range even more difficult. And if you're tired of losing, quit doing the hard stuff. Do the easy stuff. So zone one, zone two, or range one, range two, all of that would still be a part of range. If we get to keep this inside day breakout, then you can recognize the opportunity or the fact that we are no longer inside of yesterday's range. We are in an inside day breakout. We've buzzbeat off of that low of yesterday, and that we could just now maintain this downward day. That we could break our own Globex low, continue through more lows from there, and begin threatening 38.40, 38.30 onward down. Looking at our ADR of 2.8, we're only down 0.5. There's 2.3 to the downside from our current location that we could travel, and it would not even be considered an unusually large move. So 2.3 would get us right around 38.20. That would be our ADR to the downside. Taking things in the other direction, and I've said these kind of things before, and then it's gone and done it. There is the idea that we could have a topside breakout. It's very unlikely that we're going to get a topside breakout, but just because it's unlikely doesn't mean that it won't happen. At least once last week, I said that it was very unlikely that we would have a bottom side breakout because we were sitting at the top of a very large range after the Fed had given that their speech. They came out, we rallied really hard, had a massive move to the upside, and the next morning in the morning briefing, pointed out the downside, had the same discussion, and said it's very likely we're going to break through the bottom of yesterday's range because of how big the day was. Well, we managed to do it anyways, right? So just because something is unlikely doesn't mean that it can't happen. So we could rally all the way through yesterday's price action and break through the top. It has to have a part in our discussion because it is something that could happen, especially in the current volatility where we've been getting these really big moves. Some of the best bull market days or best, positive days in the history of the marketplace happened during bear markets. So the idea that we could have an upside rally is totally on the table, especially since I've heard a lot of the secret words, oversold, 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 oversold. I've been hearing that for the last 2 days. Everybody's looking for the rally. I personally don't like those words. I don't like to use them in my analysis. I don't like to use them when I'm looking at an indicator. They imply that stocks have some base level that once we've gone past that, it's almost deserving of a buy. Nah. But either way, suppose we do get the upside rally. To get there, ADR of 2.8. we're down 0.5. Add that 0.5 to the 2.8, you get 3.3. So from our current location, 3.3% to the upside wouldn't even get us outside of yesterday's price action. So we would need our own ADR plus some to get outside of yesterday's price. Also, to get there, we would have numerous pivot points to fight through. We'd have to get through yesterday's low, the close of yesterday, our own Globex high, the open of yesterday's RTH, the Globex open of yesterday, and then the intraday high, and then the Globex high. The Globex high being the high of yesterday completely and at 40.50. Should we make it through all of those pivot points and still have enough push behind it, then we could be looking at a topside breakout, and I would expect to struggle with Tuesday's intraday high at that point, and that number would be 40.66. Not a lot to unpack there when you think about the pivots that are in play. I've made the comment before of falling out of a tree and hitting every branch on the way down. But this would kind of be in the opposite vein. If we were going to be rallying today, we would be hitting all of these on the way up. Every one of them would be a form of resistance that would have to be managed or dealt with. It would be a difficult move. However, there is one thing that would get us through this really, really quick, and that would be an impulse play. That some bit of news today out of one of these econs would be so powerful and so galvanizing that we just get this absolute rip in one direction to the upside, and it would break right through all of those pivot points. Something like this red candle from yesterday. I know now that I've zoomed in, that red candle doesn't look like much, but when I zoom back out, that was a very large move in the market. And it went through everything that was in its path to the downside. It didn't slow down at all. There was no stopping that thing with pivots or support or anything like that. Flip that over and get the same kind of price action to the upside, which is absolutely possible, then we could break through a lot of these pivot points and thus get those out of the way, so that when it did finally start to slow down, we would already have been through the worst of them. Looking at a 10-day, 30-minute chart, we are outside the box. We are a long ways outside of the box. And as I often talk about, you have to think about where the bottom of the box is, where price is, and where price is going. Is it moving farther away from the box, or is it moving back towards the box? Our normal expectation is if we're out of the box, we expect to see price moving back towards the box. It takes a lot of effort to continue to drive price farther away. And so our expectation is that we would expect under normal conditions to see price begin coming back the other way. If it doesn't, it just adds to our overall bias that it takes a lot of negative pressure to continue to move farther away, and that we don't want to stand in the way of that energy and go with the flow. There's a large area of volume around 4,000. So in that discussion where I was calling out those pivot points to the upside, talking about yesterday's low, yesterday's open, the Globex high, all of those pivot points, we also have to add to it that there is a massive level of volume, which includes volume around the COG line, the COG line at 40.11, and basically an entire zone from 40.25 all the way down to 4,000. You could maybe shorten that up a little bit and make it from 4009 or 10 to 4025. Anything in that area is going to be a significant level of volume nodes or volume resistance. If we do happen to break through the top of yesterday's price action after Tuesday's high, you've got a very nice shallow area. We should be able to move through that relatively quickly, and then we will come into contact with an anchored VWAP. But that would be around the 41.11 COG line at that point, and we'd still not yet be at the point of control. those are some real far away levels and are highly unlikely to be reached today. On a 5-day, 5 minute, there is a point of control from yesterday that, as of right now, is what we call an untouched point of control. It's a virgin POC. Now, with that virgin point of control, should we start to get near it, it will become a gravity point and we will begin to gravitate towards it. It is very, very close to the cog line, 4411 or 4011. 44, we're quite a ways away from that. 4011 is the cog line. So also a center of gravity. As two gravity points really close together, if we start to get near that, we're going to go to it. Think about that, right? Two people leave to go to the mall in two different vehicles. You don't necessarily need to know which path they're going to take. You just need to know their destination, right? Where are they arriving? Not necessarily what path they took to get there. If we break through our own Globex high today and we begin working through yesterday's levels to the upside, it's very, very likely that we're going to go to 4011, to the point of control, or to the cog line right in that zone. You know the destination. It's really something to think about, right? And I've traded that way for a long time. You should be comfortable and willing to draw forward using the right side of your chart, right? Using the right side of your chart, drawing on the right side rather than looking at what has already happened and doodling on old price action. Draw on the right side. Draw out what you believe or what you think will happen. For an example, this is an old picture collage that I've kept around for a long time. I keep it as a reminder because on this day, I actually had an opportunity to just slowly take the pictures as everything began to unfold. At 6:30 in the morning, I drew out the trade using the right side of the chart. I drew out a planned Busby that price would break through this resistance, pull back into it, offer me a Busby entry, and then we'd run to around 95.70 ish. 45 minutes later, we got the Busby. And by 9 a.m., we were at 50.70. And I had to close the trade out because we got too close to the RTH, too close to the open. And I closed it out. Drawing out the anticipated price action, whether you trade it or not, can help validate to you that you actually know what the heck you're talking about. Because if you keep drawing it out, you keep drawing what you think is going to happen, and then price proves to you that you were right, it will help with that conviction that a lot of you suffer from, that you don't trust your own analysis, you don't trust your own theory. Prove it to yourself. Prove that you're on the right track, that you are doing it right, that you are right more than you are wrong. It also helps for those of us who say, oh, I knew it was going to do that. I hear that way too much. I knew it was going to do that. Of course, when I ask someone who makes that comment, well, you traded that, right? You made money? No, I didn't actually trade it, but I knew it was going to do that. Well, if you knew you was going to do it, then you should have traded it. And if you didn't, then you didn't know. Draw it out. Prove it. It will help you with your analysis. It's a good trick. It's a good tool. It's a good learning tool, right? So work on that. Think about that. Draw on the right side. Even do more than one. You can have more than one theory. Every day we talk about 3 different theories. I present all 3. That we would be range bound, that we would break down to the downside, or that we would break up to the upside. So draw out all 3. Draw out what you anticipate the market could do. Learn to recognize that these price actions, for the most part, are things that we have seen before and that we will see again, right? So if they are common and normal things, if you can start to draw them out, you will increase your ability to recognize them. It is a very helpful, very useful thing to do. The difference between a COG and a POC is that COG is only on the ES. It exists nowhere else, only on the ES. And the validity of a COG is not just the 11s. There is so much more than that. I only use the 11s because I'm busy and I don't want to go through the hours of painstaking work to find all the other COG points. So I only target the 11s, and they only exist in the ES. Whereas with a POC, they exist anywhere that you put a volume profile up. And you can put a volume profile up on anything. For the Nasdaq, the range would be the same discussion from our own Globex high to our own Globex low. We are on an inside day breakout, which would add the second bit of the range. So if we break to the upside through our own Globex, we're still going to be range bound because we'll be inside of yesterday's price action. All of that would be considered range to me. From 12,500 all the way down to 11,800, all of this would be considered range. But if you break it down into zones, I find it so much easier to trade, right? Because then you've got two different aspects. You got our own Globex as its own zone, its own criteria, look left and have opportunities. But we are outside of yesterday's price action. So right now we're inside day breakout. And that prevents its own opportunities and is a part of a wider analysis. Should we continue this move to the downside, expanding our bottom here, then we would want to focus on identifiable targets, opportunities, say with Fibonacci or with the quad tool. That quadrant tool is a very useful tool in the idea that you can use it on head and shoulders, rising wedge, rectangles, cup and handles. You can use that quant drawing tool on just about everything. And while I only have it set at 50% and at 100%, you most definitely could add other percentages in there, like 25%. The Fibonacci that I use has a target of 1,236. Well, that's very close to 125, right? So you could use something like that and add it to the quant tool. And that would at least give you your target. The downside move has to be recognized in relation to the volume profile. We can start with the 5-day, 5-minute. There is an untouched point of control at 12.3, or very close to that, 12.289, right around in there. Just recognize there's an untouched point of control, and it will become its own gravity point if we get too close to it. And on the 10-day, 30-minute, we are outside of the box and we are moving farther away from the box. It takes a lot of sustained effort to continue to drive a market farther away from that box. I didn't mention it on the ES, but I should have. Notice how wide the box is and how far away the point of control is. Remember that this is a volume profile. And when it comes to volume in the futures, it's a little bit of a surprise. It's a real lack of volume. I think it's almost worth bringing it out onto the higher time frame to see this. That volume looks good in the Nasdaq, but on a day where we were selling off, we were actually down in volume, and the level of that volume, where the volume was at, that's what really stood out. I didn't catch this, by the way. I seen it pointed out by somebody else, so I don't want to. I'm not taking credit for somebody else's work. But there is a level that we focus on in the ES, especially. Every one of the futures has their own number, but on a 1-minute chart in the ES, 10,000 contracts a minute is a typical red light warning, heads up. If we break to new lows on the day, if we're picking up steam to the downside, if we're really negative, we should be seeing some real action in the market. Look at Look at the action yesterday. We continued grinding through yesterday, just lower and lower, breaking new levels, continuing that advancement down, and there was nothing. An occasional spike that never got to 10,000. This is not capitulation. This is not chaos or fear. It is very controlled, very systematic. This is like clocking in to go to work, boring price action. And it's not done. Not by any stretch of the imagination. It's not done. The lack of volume out there is a little bit of a surprise. It's a little bit of a surprise, and until it picks up, I would expect a continuation of the same, just the grind. Since we've been having the discussion of overbought and oversold, it is worth, for those of you with the longer term portfolios, to really consider some long term buy and hold on things like Google or Amazon or even the legacy names like Microsoft and Apple. If you are going to start buying around these levels, it's not done falling, by the way. So if you start buying at these lows because of its really great valuations, you're going to take pain. But if your goal is 10 or 12 or 15 years out, you're not going to care, right? And they call it averaging in. In the last 10 years, every time we've had a major pullback, they've been buying opportunities. But in all of that, we weren't in a recession. The United States and the world was not in a major economic recession, right? So we came out of those downturns in the market really quick. The Fed was able to use tools to like give the market a shot of adrenaline, and it would just rally back up again. The plunge protection team was on the ball, and they just kept bringing the market right back up. But that's because we still had an economy that could sustain it. But we're getting into a recession. We're getting with this inflation, and they can't fix inflation the way they were able to fix a waning economy, right? Things would start to slow down, and they would just give the market a boost, throw more money at it. Well, you can't throw more money at this problem. In fact, it would just make the problem worse. So they can't fix it without just severely crippling global economy. So we're not going to come out of this anytime soon. But there are still companies that are going to be able to make money with all of that going on. If you think about Amazon and the idea that people would shop there, if that's your first thought, you're thinking about Amazon from the wrong perspective. It has a cloud computing side, and that's the moneymaker of Amazon. Not their online sales and their delivery services and all that other stuff. Yeah, that makes money. The real one is the cloud computing, and that is continuing to grow even now. And it's going to continue to grow even during all of this chaos that's going on out here. Companies like that have multiple avenues to be able to make money, and that kind of diversification and that kind of strength, there are opportunities. So if you were to start buying at around these levels in some of those legacy Walmart darlings, oh, you're going to take some pain because we're not done falling. But I was taught that you have to start buying while we're still falling because nobody can call the bottom. And if you wait until we actually do bottom somewhere, we would only know that was the bottom after we've rallied far enough away from it that we can all look back at it and say, yep, that was the bottom. That's the only valid bottom that exists. And so you have to start picking up your longs while we're still falling. But be careful with what you choose. Airlines and cruise lines and casinos and resort hotels, those look really good too until you start looking at their fundamentals. They're bad credit companies, poorly managed. They suck at taking care of their money. They're just really bad choices. Right? Focus on things with really good fundamentals. Focus on things that have known CEOs, either because they brought in a guy to fix something or because the guy has been running things forever and ever, right? If you want deeper insight on that, find products that can give you that insight. I use IBD, but IBDs is not necessarily a cheap product to use, right? But I know that I'm handicapped. I don't do a good job of digging through the fundamentals. I know that. And I don't bother to go study all the fundamentals because I've got other things that I want to study. I just buy a tool that helps me do that. Investors Business Daily does a really good job, but there's Seeking Alpha, there's, oh, I don't know, FinViz Pro. There's a lot of tools out there that can help you divvy up those financials and give you a better understanding about it. So if you're going to start bottom feeding and you're going to start building out your longer term portfolio, and think about it, you're talking about something that you're going to give to your kids someday or something that you're going to give to the grandkids. It's going to be a 20, 30-year portfolio that you're not looking to see returns next week or next month. Make sure you're getting into companies that are still going to be around longer term and that they're well-run companies with some real numbers behind them. Not these SPACs, not the airlines with their bad credit ratings, right? I did a deep dive on Walmart, Nicole, probably a year and a half ago, and I started allocating quite a bit of capital into them. And then they got into a fight with um, the federal agency that regulates drugs. They got in a fight with them over their pharmacies, and I closed all of my position because I didn't think it was going to turn out too good for Walmart. They literally sued the government, and the government was suing them, and there was just this huge, big old fight over their pharmacies, and I bailed on that position, which I bailed with profit, so I didn't feel that bad about it. But I mean, I was getting into it back in here 2019 ish, I think, and the videos are still on YouTube, on the Bullish Bears YouTube. So I did my deep dive here. I got out, I don't know, somewhere right in here in the next year. And, we haven't really done much since then. But if you look at it, Walmart's still looking pretty healthy. Be careful with those too. If we're thinking about what has not yet been beaten down, right? All the things that have not yet fallen are going to be the things that they target the most to crush, right? So especially the tech darlings, like you start going through the fangs and looking at who in the fangs have not taken the beat down. Those are going to be the ones that take the beat down in the next, I don't know, however many weeks that before we start to see this really, really crippling capitulation, which I honestly don't think we're going to see. You know what I mean? Like, we've all been trading that way for 10 years, right? Or at least, I mean, that's what the market's been doing 10 years, that we get this serious pullback, then we get capitulation and we rally back up. And then it was the same thing and we rally back up, and the same thing and we rally back up. If you go look at the dot-com bubble, it took 2.5 years. Go look at the 07-08 housing crisis. It took years. So if we're in that, which is when the economies were down, and it wasn't just the stock market, it was global economies, then we're not going to see a capitulation and a rally back out. We're going to continue to see all of these numbers get cut. And if you're trying to think about, well, what kind of cut, this line is pre-COVID. Half of that would be a really good place to start. So how far are we going? At least back to where we started in COVID, pre-COVID, 340. Then if we want to start talking about how bad it can get, 260, 270, 280. And if these seem extreme, if you're looking at these numbers and thinking, no way, dude, it's not going to get that bad, then as Casper just mentioned, IWM just got there yesterday. Thanks, Casper. I appreciate that. Let's see that. Bum, bum, bum. Pre-COVID, take half of that. You're looking at small caps at around 130. Look at how much the market devalued itself during the 07, 08, or during the dot-com, right? We're talking about a 50% haircut in the entirety of the market. So we're not done yet. And the things that will be targeted will be things that have not yet taken the fall, things that are not yet beat down that bad. Now, on the Walmart side of things, or on retail, or on defensive stocks, right? If you think about it from that point of view, as long as all of the darlings are getting beat down, the defensives should do okay. But if we get a rout like we had during COVID, then nothing was safe, right? Everything went down during the COVID drop. But this isn't that, right? This is a completely different thing. And so what you really want to do is go back and look at the 07, 08, go back and look at the dot-com, right? And look at the names that did do good, or the sectors that did good. Energy was well. Um, there are areas and bright spots and opportunities. Um, Someone asked about ARC. It got a beat down, and I don't think it's done. Right? Look at the names that are in ARC, and that would answer your question. Well, what about ARC? ARC's an ETF. It's a basket of stocks. Look at the basket that it represents. What are the names in there? Right? And since I don't keep up with ARC anymore, I don't have any idea what happens to be in it, particularly right at this moment. But she does a really good job of sharing everything that she does. She's very open about what she buys and sells, which is why so many people loved her. Right? New traders who didn't know what to buy today would just look at what she bought and then go buy that. I mean, hey, we got to get our ideas from somewhere. Great. So if you want to know what you think ARC's going to do, look at what is inside of ARC. And when it's names like PayPal and Tesla, and well, then you can go look at those individual charts and say, oh, okay, well, then, there's an expectation that we're not going to rally anytime soon. So the PPI is tied in with the jobless claims, and I'm particularly interested in the revision numbers more than anything else. Just a little bit of a nerd on that aspect, but we are way off tangent anyways. Way off base. Let's get back on track so we can get this wrapped up. Good morning, kitty kitty. Glad to see I'm not the only person that's still awake in the morning in my house. Our new baby kitty just got out of bed. All right, so we covered the futures. At least we covered the indexes. Let's bring the rest of them in. Yesterday, I spent a lot of time hanging out in the large caps. Well, it's not a large caps anymore. I spent a great deal of time yesterday calling out analysis on the day. Right? And what I hear from people all the time is, well, sure, it's really easy to go back afterwards and point out where really good trade opportunities were. And you're right, doing that kind of backseat driving is a really easy thing to do. But if you go back and look at that backseat driving, you'll figure out what those signals look like, and you can begin to recognize them before they happen. I did a video on this. I'm waiting for Lucian to get it published. Once it's published, it'll be in the Next Level Futures library. He said to remind him in a couple of days, which means he doesn't really seem that fired up to get it done. So if you guys want to remind him that you want this video from the Next Level Futures, a little poke with the stick to get him on the ball and get the video uploaded, that would be awesome. It would get done faster. So targets were called. If we break 4402 or 4002, then we will target the RTH open. We'll go back a little farther than that. Every one of the targets from where we started to turn over yesterday and head to the downside, they were all called out. We were targeting 4002. When we got there, we started targeting the open. When we got there, we started targeting the bottom of the 5-minute open range. When we got to that, we talked about coming back up and tagging against the underside of it. Every one of these were called out. Every discussion about, okay, we're underneath it, now it's our resistance, we're going to come up and tag it. Every one of these moves through the market yesterday were laid out in advance, right? So that when we began to fail here, all the way down through the day until around 2. I finally said, all right, that's enough. I got something else to do, and went and did something else. The entire drive from around 11 o'clock to 2 o'clock was all called out step by step. Where are we going? What's our next target? What are we doing? What's our next target? So watch the chat through the day. Even if we're not live streaming, there's still something in there that can help you navigate the market. And it wasn't just the ES. I called out some targets in the SPX as well for those of you who don't trade futures, but still want to participate in the intraday in something like SPY, SPX, QQQ, things like that. The opportunities are there. All right. So having said that, bring in the futures, the other things that we look at. Bitcoin got one heck of a haircut, and it's reacting to mean reversion at the moment. Keep your eye on that for an opportunity. If we continue this swing high, swing low in Bitcoin, then our next move down should be around 25-ish, maybe in the 24s. It depends on this rollover, honestly, because everything is measured, right? We talked about that quant tool just a little bit ago. It works just as good for this as everything else. Start with your linear regression line and take it out how far it moved. That gives you your target in the other direction, right? And so this pullback, if it crosses back down through that linear regression line, then the sweeps are getting smaller. The sweeps should be equal on each side. So if we went this far on one side, we should go that far on the other side. If we don't, then it's showing that the swings are slowing down, and 24.5 is no longer on the table. 24.5 would not be something that I would target. I would instead target something around the same low that we already had, 25.4, maybe 26. Why are we talking Bitcoin? Well, because Bitcoin has become so institutionalized now that it is as relevant as the rest of the market, right? It's no longer just something that we randomly look at a little bit. It has drive, and it will absolutely affect order flow. Gold is another one. Remember, gold is a hedge on inflation, so we definitely want to keep our eye on gold. This is not a market hedge, right? People don't get into gold because they think the stock market's going to crash. That's worthless. That won't help. They use gold as a hedge against inflation. Keep track of energy. Energy has been poo-pooed on for years that it no longer has an impact or a drive in our market. And it has proven in the last 4 months or 5 months that that is absolutely not true, that it does have weight in our world today and can still be an absolute catalyst to our daily market, right? And then we got the dollar and the bonds. The dollar is continuing that drive again today. Look how much it's already advanced this morning. We're looking for the dollar to get above 105 today, and it ain't done. It's not looking to slow down anytime soon. Continue to keep your eye on the bonds. We have seen an absolute correlation in the market lately that when we start going down, everything is going down, right? It didn't matter. It was bonds, it was gold, it was oil, it was the stocks like the Nasdaq and the S&P. Everything has been tightly correlated and has been a serious beatdown. Well, we're decoupled this morning. Stocks and bonds are not moving in the same direction. We really want to see if that sticks and holds, right? So we want to keep our eye on these two. They are our valuation and they are opportunities. They're a part of our confirmation. Someone asked about chat. The chat that I was referring to is the Bullish Bears Discord. So if you are a member of the Bullish Bears, you can go to our website and from there join our Discord. And we all hang out in the trade room where we live stream through the morning. And then we have the chat for the rest of the day, calling out trades, trade ideas. Of course, if any trades are taken, we have a trade alert channel, which also is a place where we post things. Oh, there absolutely is going to be more pain coming. We're nowhere close to the bottom. As for buying into Bitcoin or any of the other digital currencies, it would be the same conversation that we just had about all of the other stock out there. Make sure that the coin you're buying actually has something behind it. and is not just some meme, right? And expect more pain. If you start buying into coin, it's not done falling either. But you got to start buying while things are still going down if you're going to be looking at long-term buy and hold portfolios, which are still used, right? I know Bullish Bears really focuses on trading on a day-to-day basis, but I've got over 15 different brokers that I use, and some of them are long-term buy and hold brokers, right? So not everything that I trade is getting in and getting out and worrying about the day-to-day. Some of my stuff is really long-term, things that I honestly do think about giving to the grandkids someday. Well, a relief rally of what? A day, 2 days, 3 days? When you ask about is there still more pain coming, I don't know what kind of time frame you're thinking of. You talking about the next 10 minutes or the next 10 days? We are severely beat down. You would expect that in the next 2 or 3 days we should get an upside move. Dead cat bounce at least, right? So relief rally? Sure. A day, maybe two, three, a week? Sure. Are we done? No, we're not done. So go out and look at the higher time frames. Look at the breakdown in the last few days. Linear regression and mean reversion alone says we're going to pull back, that we're going to at least pull back to 4,000. Today, I don't know. Nobody knows. And anybody who says they do, let them put their money where their mouth is and show you the trade that they're taking. That's what I got for you guys. Be careful, be safe. I'll see y'all tomorrow.